Welcome back to the Deep Dive, where we plunge into the heart of industries and companies that shape our world. Think about your last trip, whether it was for business, pleasure, or maybe a little bit of both these days. Chances are one of the true titans of the global travel industry had a hand in it somewhere along the line. Today, we're taking a deep dive into one such titan, Marriott International, Inc., ticker symbol MAR. We're talking about a company whose name has become, well, pretty much synonymous with hospitality, luxury, comfort, and let's be honest, sometimes that surprisingly decent breakfast buffet.
Right. And our mission today is to really unpack a comprehensive investment analysis of Marriott. We're going beyond just the glossy brochures and the quick online reviews. We're looking deep into their strategic position in the global market, the really formidable competitive advantages they've built over decades, their current financial health and trajectory, and critically, the evolving market challenges and, well, the dynamic opportunities that are going to shape their path in the years ahead. It's about truly understanding the intricate engine behind this global hospitality machine, not just sort of watching it from the outside.
Exactly. Think of this as your shortcut to understanding not just the single company, but an entire sprawling industry that touches nearly everyone's lives, often in ways we don't even realize. When you think about a brand like Marriott, what first comes to mind for you? Is it just the sheer number of options under their umbrella? Or maybe that loyalty program, Bonvoy, that seems to be everywhere? Or perhaps it's just that feeling of, reliability, consistency when you're miles from home. We're going to explore precisely what makes it tick, from the big macroeconomic shifts redefining travel, all the way down to the intricate financial levers that power this huge empire. Okay, let's unpack this then. The global hospitality industry, it's truly been on nothing short of a roller coaster ride over the past few years, hasn't it? I mean, we saw a complete, unprecedented global shutdown that just brought travel to a halt, and then almost overnight, this furious, almost frantic rebound as all that pent-up demand just exploded. It was dizzying. But now, as we move into 2025, the picture seems to be shifting again. We're entering a new phase, and understanding its nuances feels absolutely crucial.
Indeed. It's been quite the ride. The data clearly shows that international tourist arrivals in 2024 actually managed to match the pre-pandemic 2019 levels. We hit a pretty robust 1.4 billion globally. That's a truly significant milestone, really. And it was largely fueled by what many in the industry kind of affectionately termed revenge travel, people desperate to get out, explore, make up for lost time after being cooped up. That period was characterized by this, well, almost irrational surge in demand sometimes. However, this robust and frankly somewhat unsustainable rebound, it's now transitioned into something fundamentally different, a period of normalization.
Okay, normalization. And what does that actually mean for growth? Because, it sounds like a bit of a polite way of saying slowing down. What are the subtler nuances here? Is it just slower growth or is there something else changing? What does it mean for, say, individual hotels within Marriott's huge portfolio?
You're right to pick up on it. It's not just slower. It implies a crucial shift in dynamics. In essence, yes, it does mean significantly decelerated growth compared to that frantic recovery phase. So, for example, in the really key U.S. market, revenue per available room RevPay, that crucial metric combining occupancy and average daily rate it's projected to slow down to a pretty modest 0.8% to 2.6% growth in 2025. Now, to put that into perspective, immediately after the pandemic, we saw RevPay figures in many U.S. markets surging by double digits. Sometimes, over 20% year over year. It was wild. That was just pent-up demand being unleashed. Now, though, the forecast for 2025 paints a much, much more subdued picture. And this isn't just a number. It fundamentally shifts how hoteliers have to operate. It means they can't just rely on, hiking prices dramatically anymore to drive revenue. They have to focus far more acutely on optimizing occupancy, really enhancing the guest experience to justify the prices they are charging, and controlling costs with, well, surgical precision. This slowdown also forces a rethink on expansion strategies. Where do you build?
What segments do you target when overall growth is slowing down to almost inflation levels? What's truly fascinating here, I think, is just how quickly the industry shifted from that pure recovery story, where basically any open door was a success, to one where performance is far more influenced by underlying economic conditions and, importantly, these evolving consumer behaviors. It's less about just cashing up and much more about adapting to a complex new baseline of demand.
Okay, so if that overall recovery is normalizing, what's really driving demand now?
Yeah.
Because it sounds like leisure travel, which, really led the charge out of the pandemic, isn't quite the inexhaustible engine it seemed to be, especially with economic pressures biting.
You're absolutely right. Leisure travel, While still vital, of course, it is moderating. This is largely down to persistent inflation, just chipping away at consumer purchasing power, and a general dip we're seeing in consumer sentiment. People are still traveling for leisure, definitely, but maybe not with quite the same boundless enthusiasm or frequency, or perhaps willingness to spend quite as much as they did immediately after the lockdowns lifted. They're becoming more discerning, I think. However, stepping into that gap, a truly interesting and, I think, incredibly durable demand driver has emerged, one that Marriott and its peers are very, very keenly focused on: leisure.
Ah, bleisure. Yeah, I've heard that term. It sounds almost like something out of, I don't know, a marketing department brainstorm, but it's actually fundamentally changing how we think about travel, isn't it? Blurring those lines.
Absolutely, it really is. Bleisure is that integration of business and leisure travel, a sort of hybrid approach. And it's so significant now that over half of industry experts consider it the single greatest opportunity for expansion in the coming years. This trend is largely enabled by the widespread adoption of flexible and remote work policies pretty much everywhere. So business travelers are increasingly extending their trips for personal vacation time, maybe adding a weekend or a few extra days onto a business engagement. This naturally leads to longer average stays and often a higher overall spend on things like amenities and local experiences. And this isn't just seen as a fleeting trend. It's widely considered a profound structural shift in how people travel. Projections are suggesting that business travel visits will grow by about 50% by 2030. That's actually a significantly faster pace than leisure's forecast, which is around 30% growth.
You know, what really fascinates me about this whole work from anywhere thing isn't just the longer stay, though that's important. It's how it might be blurring our whole perception of travel. I mean, I can personally vouch for this. Just last month, I tacked 3 extra days onto a conference, found myself taking a couple of video calls from a cafe overlooking the beach. It completely changes a work trip into something genuinely enjoyable. Are we actually seeing people choose destinations because of the Wi-Fi and maybe co-working spaces, even for leisure? And how does a company like Marriott capitalize on that beyond just the traditional road warrior? Are they rethinking their actual physical spaces?
That's a really perceptive observation, and it's exactly what the industry, Marriott included, is actively grappling with right now. What's truly insightful is how Marriott is rethinking its physical spaces to accommodate this. We're seeing brands like, say, Courtyard or Residence Inn, even their newer studios concept, which traditionally served maybe solo business travelers or longer stays, they're now designing rooms with dedicated higher-spec workspaces. Think better lighting, ergonomic chairs, really robust connectivity naturally. But alongside that, more comfortable lounge areas, or even adding flexible common spaces that can double as casual meeting spots during the day and maybe family zones in the evening. This isn't just about offering longer stays. It's about fundamentally shifting the function of a hotel room from just a temporary stop to potentially a third place, somewhere between home and the traditional office. This is especially true in urban and resort markets. They're targeting people who might work remotely for a few weeks from a completely different city, blurring those lines between a permanent home and a vacation spot. So while bleisure is definitely surging and reshaping demand, it's also important to note that traditional, pure business and group travel, they're still in a more gradual recovery phase. Full inflation-adjusted recovery for overall business travel spending isn't really anticipated until after 2028, based on current forecasts. However, group travel, think larger conferences, conventions, corporate events, that actually showed pretty robust demand throughout 2024. That segment seems quite resilient, perhaps because in-person meetings, team building, large corporate gatherings, they still seem to be a priority for many organizations. It underscores that enduring value of face-to-face interaction, I suppose. Hashtag C. Macroeconomic headwinds and operational pressures.
So even with these interesting shifts in demand like bleisure and these new opportunities, the broader economic environment still seems to be casting a pretty long shadow over the hospitality sector, doesn't it? It feels like a constant balancing act.
It definitely is, and it adds significant layers of complexity to everything. The industry is navigating some genuinely significant macroeconomic headwinds that, well, hoteliers simply can't ignore. We're talking about a sustained period of elevated interest rates, which hits everything from consumer borrowing for travel to the cost of actually financing new hotel developments. Then there's persistent inflation projected at 2.7% in the U.S. for 2025, which just eats away at consumer purchasing power. And coupled with this, we're seeing a general slowdown in GDP growth, with the U.S. forecast at a pretty modest 0.7% in 2025. These aren't just abstract economic numbers. They have a very direct, very tangible impact on consumer discretionary spending. When people feel the pinch in their wallets, they tend to cut back on non-essentials like travel.
This makes the lower-priced and economy hotel segments particularly vulnerable to a pullback in demand as consumers become much more value-conscious. Maybe they opt for shorter trips, cheaper alternatives, or just delay travel altogether.
And it's not just the top-line revenue that's under pressure from these macro factors, but the operational costs too, right? I imagine labor is a huge piece of that puzzle, creating a kind of squeeze from both ends.
It is, and it's a significant ongoing challenge. The industry continues to grapple with really acute labor shortages, a lingering effect from the pandemic's workforce dislocation, and alongside that, persistent wage inflation. A survey from back in December 2024 showed that nearly 65% of U.S. hoteliers were still facing staffing challenges, particularly for crucial roles like housekeepers, front desk staff, maintenance. And to attract and retain talent in such a tight market, compensation has had to increase at a rate that's actually outpaced the overall economy by more than 20% since the pandemic began. That puts direct, sustained pressure on hotel operating margins. That's a big number. And it's not just labor. The operational expense pressures extend even further. Insurance costs, for example, they rose by an average of 15.3% for U.S. hotels through October 2024. Property operations, maintenance, IT costs, all critical for a smooth guest experience. And modern infrastructure, they increased by nearly 5% during that same period. This really raises an important question. How do companies maintain profitability when that top-line growth decelerates, sometimes down near inflation levels, and costs just keep climbing relentlessly? It points towards a period of potential margin compression across the entire sector, forcing operators to become even more efficient, more innovative, and frankly, more discerning about every dollar they spend.
It sounds like a really tough spot for the individual hotel owners on the ground, but does this asset-light model that Marriott champions offer any insulation from these direct operational costs for Marriott itself, or do these pressures kind of ripple up to them too, eventually?
That's a fantastic question. And it gets to a key nuance of the asset-light model. So while Marriott doesn't own the physical real estate for, 99% of its hotels, meaning the owners and franchisees bear the direct brunt of these property-level operating expenses like wages, insurance, maintenance. Marriott isn't entirely immune, not at all. Their management contracts often include clauses where their incentive fees are tied directly to hotel profitability. So if a hotel's profits get squeezed by higher labor and operational costs, Marriott's incentive fees will also naturally diminish. Less profit means less incentive fee. Furthermore, for their managed hotels, where Marriott is directly responsible for operations, they absolutely feel the direct impact of these cost pressures on their own books. So while the financial risk is largely diversified across thousands of owners, the earnings potential of Marriott itself is still fundamentally linked to the underlying profitability of those individual properties. It actually pushes Marriott to work even more closely with its owners to find efficiencies and optimize operations. They almost become a partner in cost management, as well as just driving revenue.
Okay, so we've talked about the broader trends, the macro pressures, the operational squeeze, but how do these translate into the actual numbers, the tangible performance markers for the U.S. hospitality industry? When we dig into the KPIs, what story do they really tell about this period of, normalization and pressure?
They tell a pretty clear story, and an increasingly urgent one, I'd say, of moderating growth. And that growth is primarily being driven by pricing power, rather than just sheer volume of travelers filling rooms. Let's break down some core metrics for the U.S. market. For occupancy, U.S. hotel occupancy is forecast at 63.38% in 2025. Now, while that's a significant recovery from the pandemic low in 2020, which was around 43.89%, it's still noticeably below the pre-pandemic 2019 level of 65.80%. This suggests that while more rooms are definitely being filled than during the crisis, we haven't quite gotten back to previous full capacity. It probably indicates that leisure demand hasn't fully offset a still somewhat slower business travel recovery.
Interesting. And what about how much people are actually paying for those rooms they're filling? Is pricing still holding strong, or is that starting to crack too?
That's where we see the main driver of revenue expansion in this normalized environment. Average daily rate, or ADR, has been remarkably resilient, actually. It's projected to reach a new nominal high of $162.60 in 2025. That represents about a 1.99% increase over 2024. This growth, even if it's modest, shows that hoteliers, especially in certain segments, still possess some pricing power. However, when we combine occupancy and ADR into that really crucial metric of RevPAR, or revenue per available room, the overall growth picture becomes much more subdued. U.S. RevPAR growth forecasts for 2025 range from that modest 0.8% to maybe 2.58%. That's a sharp deceleration from the post-pandemic boom years. This deceleration really highlights the shift we've been discussing. The sort of low-hanging fruit of the recovery phase has definitely been picked. Growth is harder won now.
That paints a very clear picture of an overall slowing trend. But I remember you mentioning a bifurcation of demand earlier. Does that show up starkly in these numbers too? Because that feels like a really important distinction for a company like Marriott with its huge range of brands.
It absolutely does, and it's a critical dynamic to understand. This bifurcation of demand is perhaps the most telling trend within these KPIs right now. Through the first quarter of 2025, for example, luxury tier hotels in the U.S. saw their RevPR grow by a strong 7.1%. That's significantly robust growth. But in stark contrast, economy tier hotels only managed a meager 0.9% increase in RevPAR during the same period. This clearly indicates that higher income consumers, those perhaps less impacted by inflation and economic uncertainties, have been more resilient in their travel spending. They're still spending on premium experiences. The economy segment, however, is much more constrained. Value-conscious travelers are either trading down to even cheaper alternatives, maybe shortening trips, or perhaps delaying them entirely. This has profound implications for how Marriott has to manage its incredibly diverse brand portfolio, which runs the gamut from, say, St. Regis all the way down to City Express. You can actually visually track this trajectory in Table 1 from our sources. You see the sharp drop in 2020, the furious rebound, and then this distinct leveling off, but with a widening gap opening up between the luxury and economy segments.
Right. So, given that split in demand and all these macroeconomic pressures, what's one factor that might still provide a bit of a favorable backdrop for operators like Marriott? Is there anything working in their favor?
Well, despite these pressures, a key factor that should support profitability moving forward is actually constrained supply growth. It sounds counterintuitive, but less new competition helps existing players. Because of those elevated construction and financing costs we talked about, remember, those high interest rates, U.S. hotel supply is projected to grow by only about 0.8% annually over the next 4 years. Now, that's roughly half of the long-term historical average supply growth, which has typically been closer to 1.5% or even 2% per year. Less new competition means existing hotel operators, particularly those with strong established brands like Marriott's, have more leverage and pricing power. It helps offset some of those cost pressures and the moderating demand growth. Beyond these core numbers, we're also seeing an acceleration in certain emerging trends. Technology integration is absolutely paramount now. There's a strong focus on AI for hyper-personalized guest experiences, like automated concierge services, predictive amenity preferences based on past days, and also contactless solutions like mobile check-in, digital room keys, things like that. And finally, sustainability. Once maybe a niche concern or a marketing buzzword, it has now become a fundamental expectation for many travelers. It's genuinely influencing booking decisions and forcing hotels to invest in eco-friendly operations, not just as a PR move, but as a core business imperative.
Okay, so that's the evolving backdrop of the industry, definitely full of both challenges and opportunities. Now, let's really zero in specifically on Marriott and how it navigates these choppy waters. It's pretty safe to say Marriott isn't just a player in this space, it's arguably the undisputed leader in global hospitality. But what does that leadership truly mean in, tangible terms? How big is big?
Absolutely. Marriott International holds an truly unrivaled position as the undisputed leader in the global lodging industry. And that dominance is really defined by its immense, almost mind-boggling scale. The company boasts approximately 1.74 million rooms spread across more than 9,600 properties, and these operate under the umbrella of over 30 distinct brands. Now, to really put that into perspective, let's look at its closest competitors. At year-end 2023, Marriott had around 1.5 million rooms across about 8,800 properties. That's substantially larger than Hilton, which had roughly 1.18 million rooms. IHG, think Holiday Inn, Intercontinental, they had about 946,000 rooms. And then Hyatt, which is a much smaller, more focused player, was around 350,000 rooms. The sheer difference in scale is just staggering. Marriott is almost in a league of its own.
That is a staggering difference. It's an almost insurmountable lead in just physical presence, it seems. So how does that translate into financial dominance? And maybe more importantly, what kind of competitive advantage does that sheer immense scale actually create for them?
Yeah, it translates directly and very powerfully into financial dominance, which then in turn reinforces its market leadership. It's a cycle. Marriott's 2023 revenue, for instance, was $23.7 billion. That was more than double that of Hilton, their closest competitor, which came in at $10.2 billion. This leadership in both physical footprint and revenue generation provides a really robust foundation for all its other competitive advantages. And if we connect this to the bigger picture, this immense scale creates a sort of self-reinforcing, almost virtuous competitive cycle. It feeds itself. More properties globally make their loyalty program Bonvoy exponentially more attractive to a vast global base of travelers. Why? Because members know they can find a Marriott brand almost anywhere they want to go.
That in turn drives more direct bookings through Marriott's own channels, which are significantly more profitable for the hotel owners because it avoids those costly third-party OTA commissions. This high profitability then makes Marriott brands highly desirable for prospective hotel owners and developers, which fuels further growth in their development pipeline, adding even more properties. This virtuous cycle creates a truly formidable barrier to entry for smaller competitors who simply lack the critical mass, the scale, to compete effectively on such a global stage. You can really see this pronounced gap between Marriott and its peers in terms of properties, rooms, and revenue laid out clearly in Table 2 from our sources. It's not just about being bigger, it's about being structurally advantaged by that size.
Right. So when you talk about these formidable barriers to entry, how insurmountable is the scale really? For a new player or even a smaller competitor trying to catch up, does anyone realistically stand a chance of chipping away at this dominance in a meaningful way?
That's a crucial point. For a new player to enter the market today and try to achieve anything even close to Marriott's scale, well, it would require an absolutely astronomical amount of capital, billions upon billions. It would also take decades of brand building across multiple segments and developing an incredibly sophisticated global distribution system and loyalty infrastructure from scratch. It's frankly effectively impossible in today's landscape. It's too late, the gap is too wide. For smaller established competitors like, say, Hyatt, the strategy isn't really to match Marriott's scale head-on. They can't. Instead, they differentiate. They focus on specific segments, often luxury or lifestyle, where they can command premium pricing and build strong brand affinity without needing that sheer volume of properties. Even a large player like Hilton, while certainly growing and a formidable competitor in its own right, is still significantly behind in terms of total property count and global footprint. It takes decades to build that kind of network. Marriott's dominance is really a product of early mover advantage, decades of relentless execution, and a history of very strategic acquisitions, like Starwood. Its ecosystem has reached this critical mass where it becomes somewhat self-sustaining and incredibly difficult for others to disrupt significantly. Think about it. Any new hotel developer, when they're weighing their options for which brand flag to fly, will inevitably consider the enormous marketing power and the booking engine that comes with the Marriott flag. It makes it a very, very compelling choice that few others can truly replicate on that scale.
Okay, so beyond just the sheer numbers and that massive physical footprint, Marriott is also known for its incredible portfolio of brands, isn't it? Everything from, economy options right up to those ultra luxury experiences. That must be a huge part of its competitive edge, too, offering something for pretty much everyone.
It certainly is, and it's a strategically brilliant aspect of their dominance. A key pillar of Marriott's competitive moat is absolutely its comprehensive brand portfolio. It's truly the most extensive in the entire industry, encompassing over 30 distinct brands now. And this spans every conceivable market segment, catering to just a vast spectrum of travelers. You've got affordable mid-scale brands like City Express, especially in Latin America now. You have solid select service options like Courtyard and Residence Inn, which are workhorses for business travel. Premium full-service brands like the flagship Marriott and Sheraton, all the way up to iconic luxury labels that everyone recognizes like the Ritz-Carlton St. Regis and the trendy Edition hotels. This brand for every stay approach is incredibly powerful strategically. It allows Marriott to capture a really wide spectrum of travel demand. They can cater to diverse preferences, different price points, various trip purposes, whether you're a student traveling on a tight budget, a business executive needing efficiency, a family on a big vacation, or a discerning luxury traveler seeking pampering. This breadth gives them a significant competitive advantage over peers who might have more concentrated portfolios, like Hyatt, for example, which tends to focus much more heavily on the luxury and lifestyle segments, and thus misses out on huge chunks of the overall travel market.
So they've genuinely got almost every type of traveler covered, regardless of their budget or why they're traveling. But what really cements customer loyalty in such a vast ecosystem? How do they ensure people keep coming back to a Marriott property, even if it's a different brand each time? I imagine the Bonvoy program is absolutely central to that whole strategy.
Oh, absolutely. It's not just central. It's arguably the single most important component of their entire competitive moat. The Marriott Bonvoy loyalty program is a truly colossal asset. It boasts nearly 248 million members as of the second quarter of 2025. Just think about that number. It makes it one of the largest and most powerful customer relationship platforms in any industry, not just hospitality. The program's primary function is really multifaceted. Of course, it drives repeat business. It encourages higher spending within the Marriott ecosystem. Members often choose Marriott restaurants or spas. And, crucially, it incentivizes those direct bookings. In Q2 2025, Bonvoy members accounted for a record 69% of occupied room nights globally. almost 70%. This is a critical metric because, as we mentioned, direct bookings, those made through Marriott.com or the Bonvoy app, are significantly more profitable for both the hotel owners and for Marriott itself. Why? Because they avoid those substantial commissions paid out to third-party online travel agencies, the OTAs like Expedia or Booking.com.
Wow, 69%. That's a massive percentage of their occupied rooms coming directly through their own channels. So it's not just about loyalty in the traditional sense. It's basically a massive integrated sales channel they've built over years. But are there any other benefits for Marriott from Bonvoy beyond just getting those direct bookings?
There absolutely are. While some competing loyalty programs might occasionally offer slightly higher per-point redemption values on paper, Bonvoy's sheer scale, combined with its truly unparalleled variety of redemption options across that vast global portfolio, from free nights at thousands of hotels to unique travel experiences, even converting points to airline miles. It creates an incredibly powerful overall value proposition for travelers. The utility and flexibility are just unmatched globally. Furthermore, and this is a significant point that often gets overlooked, the Bonvoy program also generates a substantial and growing stream of high-margin non-RevPAR franchise fees through its co-branded credit card partnerships with companies like American Express and Chase. These partnerships bring in millions upon millions of dollars annually just from card usage fees and sign-up bonuses. It diversifies Marriott's revenue streams with highly predictable, fee-based income that isn't directly tied to whether someone actually stays in a room that night. It's pure profit, essentially.
So what does this all mean for you as a traveler? It means that staying loyal literally pays off, giving you access to an unparalleled network and benefits things like free nights, potential room upgrades, exclusive member rates, access to special experiences that you just can't easily get anywhere else. It's a very clever way to lock in demand and create really sticky customers. But are there any downsides to managing such a vast, incredibly diverse portfolio of brands and a loyalty program with almost 250 million members? Does it ever become too complex to manage effectively, or does it risk diluting the individual brand experiences?
That's a perceptive question. And yes, there are always trade-offs and challenges that come with that kind of immense scale. The primary challenge with such a vast portfolio is definitely maintaining consistent brand standards and service quality across dozens of distinct brands and thousands of properties scattered all over the globe. A bad experience at, say, a Courtyard, even if it's an isolated incident, could subtly erode a guest's trust in the broader Marriott ecosystem, even if they usually stay at a completely different brand like a Ritz-Carlton. Perception matters. Marriott addresses this through incredibly rigorous brand guidelines, detailed operational manuals, and extensive training programs for both its managed and franchised properties. But it requires constant vigilance and investment. For the loyalty program itself, the challenge lies in managing member expectations effectively. With 248 million members, true deep personalization becomes much harder at scale. And ensuring that enough aspirational redemption opportunities like those top-tier hotels during peak season remain available can be tricky, potentially leading to some member frustration if points feel devalued or hard to use for the best rewards. However, at the end of the day, the overwhelming benefits of that scale, the market capture, the direct booking leverage, the negotiating power with suppliers, they almost certainly outweigh these inherent management complexities for Marriott.
Okay, one of the most talked about aspects of Marriott's business model, and indeed many of its big peers now, is how asset light it is. What exactly does that mean in practice, and why is it considered so incredibly significant for a global hotel company like Marriott?
Right. Marriott was actually a real pioneer of the asset-light business model in the hotel industry. It was a strategic pivot they began implementing quite aggressively way back in 1993. Today, as we mentioned, approximately 99% of its worldwide rooms are operated under either management or franchise agreements. What that means, very simply, is that the company does not own the physical real estate, the land and buildings of the vast majority of its hotels. Instead, Marriott essentially licenses its powerful brands like Courtyard or Sheraton or Westin, and then it either directly manages the hotel operations on behalf of an owner for a fee, or it franchises its brand and systems to an independent owner-operator, again, earning fees in the process. This model, which has since been widely adopted by its major peers like Hilton and IHG, offers several profound strategic advantages. Primarily, it minimizes the need for massive capital-intensive real estate investment. Building hotels is expensive. This, in turn, significantly reduces the risk on Marriott's own balance sheet, enhances their financial flexibility enormously, and allows Marriott to grow its brand footprint much more rapidly without tying up huge amounts of its own capital in bricks and mortar.
Okay, so they're not tying up billions and billions of dollars in owning physical property, which sounds incredibly efficient from a capital perspective. But this raises an important question about how a company like that actually generates value. If they don't own the hotels, where does their profit really come from? And does this model ever present a challenge, particularly when it comes to ensuring that all important brand consistency across properties they don't own?
Precisely. This model fundamentally shifts how Marriott generates value. The asset-light approach means Marriott earns stable and, importantly, quite predictable revenue streams through long-term contracts with hotel owners. These contracts typically include a base management fee or a franchise royalty fee, usually calculated as a percentage of the hotel's total revenues, often somewhere in the range of 2% to 5% of gross revenues. And then often there's also an incentive fee, especially in management contracts, which is directly based on a hotel's gross operating profit, or GOP. This fee-based structure results in exceptionally high returns on invested capital, or ROIC, for Marriott itself, because their capital investment is relatively low compared to the fees generated, and it generates significant, consistent free cash flow. They're effectively selling their expertise, their powerful brand recognition, their global distribution system, and the Bonvoy loyalty program access. That's the product. Now, to address your excellent point on brand consistency, that is indeed the primary challenge inherent in the asset-light model.
When you don't own the property, how do you ensure consistent brand standards, service levels, and guest experiences across thousands of hotels globally, especially when individual owners might have different priorities or different appetites for reinvestment in their properties? Marriott mitigates this risk through very rigorous brand standards, detailed operating procedures, extensive training programs, ongoing property inspections and audits, and by providing a robust central support system for things like marketing, reservations, and procurement. But it requires constant oversight and a strong partnership mentality with their owners. Ultimately, an owner's success directly reflects on Marriott's brand, so aligning incentives to things like those incentive fees is absolutely paramount. If the owner does better financially, Marriott does better too. It's a shared interest. Hashtag D, digital innovation and distribution strategy.
Right. And in today's hyper-connected world, no company, especially one operating on this scale, can achieve this level of dominance without a truly robust and, frankly, forward-looking digital strategy. What's Marriott doing on the technology front to maintain its edge and stay ahead of the curve in this constantly evolving landscape?
That's absolutely critical. Marriott is making significant ongoing investments in technology to enhance both its commercial engines, which basically means how it attracts and converts customers into bookings, and also the end-to-end guest experience itself. The company is currently in the midst of a complex, multi-year digital transformation aimed at thoroughly modernizing its core technology platforms. This includes upgrading its central reservation system, or CRS, which is really the absolute backbone of all bookings across all channels globally. And it also includes upgrading its property management systems, or PMS, which handle everything from check-in and guest requests to billing and housekeeping management at the individual hotel level. A key strategic focus within this is the Marriott Bonvoy mobile app. This serves as a primary direct channel for everything from the initial booking process and mobile check-in, check-out, to interacting with the hotel during a stay, maybe requesting extra towels, ordering room service, or even using it as a digital room key in many properties now. Back in 2022, the number of active mobile app users grew by a remarkable 32% year over year, which really showcases its increasing importance as that direct customer interface. They want guests living in that app.
Okay, and are they looking ahead to emerging technologies too? Things like AI, that seems to be on absolutely everyone's mind right now across all industries.
Absolutely, they are. The company has proactively established what they call an AI incubator, specifically to explore practical applications for artificial intelligence in various aspects of its operations. This includes exploring areas such as hyper-personalized concierge services. Imagine an AI that truly knows your preferences from past stays and proactively suggests local activities or dining options that you'd likely enjoy. And also exploring advanced customer engagement tools, where AI can potentially streamline interactions, answer common questions more efficiently 24/7, and maybe resolve certain issues even faster. This signals a very forward-looking and proactive approach to technology adoption. They're clearly aiming to leverage these cutting-edge tools to further personalize and streamline the guest journey, making it smoother, more intuitive, and hopefully more valuable. Now, a primary strategic objective behind all of this digital investment is ultimately to maximize those high-margin direct bookings through Marriott's own channels, primarily Marriott.com, and of course the Bonvoy app. This is absolutely crucial for reducing their reliance on those costly third-party online travel agencies, the OTAs, which, as we've said, charge significant commissions for every booking they deliver. The Bonvoy program, once again, is central to this strategy.
It directly incentivizes guests to book direct by offering exclusive member rates, promising benefits like upgrades or late checkout, and providing personalized offers that you simply can't access if you book through an OTA. It's a powerful combination of cutting-edge technology underpinning a deeply embedded and valuable loyalty program.
Right. So they're essentially trying to cut out the middleman wherever possible to keep more of the revenue. But how do they possibly stay ahead in this technology arms race? They're competing against other huge hotel giants and the constantly evolving, incredibly sophisticated OTA platforms like Booking.com and Expedia, which are tech companies first and foremost. What's the actual cost of this constant innovation treadmill?
Yeah, it really is an arms race, frankly. Staying ahead requires continuous substantial investment year after year. Marriott pours hundreds of millions of dollars annually into its technology infrastructure, research development, and digital marketing. And this isn't just about building flashy new features for the app. It's about maintaining secure, scalable, and highly responsive systems that can handle literally billions of searches, transactions, and guest interactions globally every single day. That's a massive undertaking. They compete with the OTAs primarily by offering a superior overall value proposition through Bonvoy, things like those exclusive member rates, elite status benefits that OTAs can't offer like lounge access or guaranteed late checkout, and creating a seamless integrated booking and stay experience that OTAs often struggle to replicate consistently across multiple independent brands. They also leverage the vast amounts of data they collect on traveler preferences through Bonvoy to offer personalized experiences and targeted marketing, which helps deepen loyalty and encourage repeat direct bookings. The cost is undoubtedly high, yes.
But the alternative, basically losing that direct connection to their customers and becoming overly reliant on OTAs, thus paying out ever-increasing commissions, is arguably far more expensive and strategically damaging in the long run. So they view technology not merely as an expense line item, but as a core strategic asset and an absolutely critical component of maintaining and strengthening their competitive moat in the digital age.
Okay, now let's really talk numbers. Marriott's financial journey over the past few years, it really tells the story of the broader industry cycle, doesn't it? But it also speaks volumes about its own remarkable resilience, I think. The last few years, with that global shutdown followed by the furious rebound, must have been an absolute wild ride for their balance sheet and income statement. Given those significant macroeconomic headwinds we just outlined, rising interest rates, inflation, slowing GDP growth, how resilient has Marriott's financial engine actually proven to be through all this turbulence?
That's a crucial question, and their financial trajectory offers a really compelling narrative of both vulnerability, because no one escaped 2020 unscathed, and also incredible resilience and recovery power. So back in the pre-pandemic year of 2019, Marriott generated nearly $21.0 billion in total revenues, which really showcased its robust pre-crisis scale. Massive company. Then 2020 hit, and the pandemic's impact was immediate and absolutely devastating. Revenues plummeted by almost 50%, falling all the way down to $10.6 billion. That stark figure vividly illustrates the lodging industry's inherent cyclicality and extreme sensitivity to external shocks like a global pandemic. However, the recovery that followed was nothing short of impressive. By 2023, the company achieved record total revenues of $23.7 billion, actually exceeding the 2019 peak. This was propelled by a substantial 14.9% increase in worldwide RevPAR that year, with a particularly significant boost coming from the long-awaited reopening of Greater China, which had been under strict travel restrictions for so long and represented a huge latent demand pool.
That is an astonishing rebound, truly a testament to that pent-up demand we talked about. But as you mentioned earlier, growth is now moderating quite significantly. How is that showing up in the more recent financials, say, for 2024 and what we've seen so far in 2025? And maybe more importantly, what about the quality of that earnings growth? How much of that record 2023 result was maybe a one-off catch-up effect versus truly sustainable growth, especially with this moderation setting in now?
Yeah, that's exactly where the narrative becomes more nuanced and requires a closer look. As we entered 2024 and moved into 2025, that top-line revenue growth has indeed moderated significantly, just as the RevPAR numbers suggested. Worldwide constant dollar RevPAR growth slowed quite dramatically, from 4.9% in Q2 of 2024 down to a much more modest 1.5% in Q2 of 2025. And this clearly reflects that normalization of travel patterns we discussed, particularly in the very large and mature US and Canada market, where RevPAR growth was notably flat, essentially zero, in Q2 2025. So the record 2023 was undoubtedly boosted significantly by that catch-up effect, a huge surge in travel as restrictions lifted globally and people engaged in that revenge travel. While some of that momentum certainly carries forward structurally, people haven't stopped traveling. The future growth trajectory will likely be more organic, more driven by underlying economic trends and Marriott's own initiatives, and less about simply recovering lost ground from the pandemic. However, the core of Marriott's earnings power lies not just in that top-line revenue figure, but in its high-margin fee revenues, which are incredibly resilient due to the asset-light model. Gross fee revenues followed a similar recovery path, hitting a record $4.8 billion in 2023. And critically, incentive management fees, or IMFs, remember, those are tied directly to hotel profitability. They also reached a record level in 2023, coming in approximately 20% higher than their previous 2019 peak. Now, this is fascinating because it represents clear profit participation for Marriott. They earn these fees only when a hotel's profits exceed a certain agreed-upon threshold. It aligns Marriott's interests perfectly with the hotel owner. If the owner does better financially, Marriott takes a slice of that upside. And this highlights the significant operating leverage inherent in their business model. As underlying hotel profits recover and grow, Marriott's earnings can actually accelerate at a faster rate than its top-line revenue growth. That's a critical factor for investors looking for efficiency and potential for disproportionate returns in good times.
You can really see this dramatic swing vividly by looking at Table 3 in our sources, the Marriott Historical Financial Summary. The precipitous dip in 2020 across the board, total revenues, gross fee revenues, adjusted EBITDA, adjusted net income, it's striking, almost shocking to see. And then it's followed by that remarkably strong V-shaped recovery by 2023. It's a compelling visual representation of both the industry's vulnerability to shocks and Marriott's impressive ability to bounce back strongly.
It really is a testament to the underlying strength and the resilience baked into that asset-light business model. After suffering a net loss in the depths of 2020, Marriott's net income quickly recovered to $1.1 billion in 2021 and then surged to that record $3.1 billion in 2023. Adjusted EBITDA, another key measure of core operating profitability that strips out some non-cash items, followed a very similar trajectory, also reaching a record of over $4.6 billion in 2023. These numbers really underscore the company's ability not only to manage costs effectively during severe downturns, they acted very quickly in 2020, but also to capitalize aggressively on the return of travel demand when conditions improve. It also vividly showcases the power of their asset-light model, which allows them to rebound financially much more quickly without being bogged down by huge amounts of property-level debt or the heavy depreciation charges that come with owning lots of physical real estate.
Okay, so with all this recovery and record profitability, what does Marriott actually do with the impressive amount of money it generates? You hear it described as a cash flow machine. Is that accurate? And what does that mean for you, the potential investor looking at this company?
It absolutely is a cash flow machine, and this is a really critical aspect of its investment appeal. That capital-efficient, asset-light model translates directly into powerful, consistent cash flow generation. Cash provided by operating activities was an impressive $3.2 billion in 2023. And crucially, this consistently and substantially exceeds their relatively modest capital expenditure needs management. Remember, they're not building most of the hotels themselves. This leaves a significant surplus of cash each year. And this consistent free cash flow is the fundamental foundation of Marriott's ability to not only invest strategically in future growth initiatives, but also, very importantly, to return substantial amounts of capital directly to its shareholders.
Right. So what does this all mean for you, the potential investor? It means a consistent, often predictable return on your capital, usually with a clear preference shown for share repurchases over just dividends. It's not just about what they earn on paper, but how they actively use that cash to enhance shareholder value.
I like so.
I've also heard whispers or seen analysis showing Marriott sometimes having a negative return on equity, or ROE. Now, that sounds like a pretty big red flag to most investors, doesn't it? Can you unpack that for us? How can a profitable cash machine have negative ROE?
That's an excellent and very important point to address because traditional metrics like ROE can sometimes be quite misleading when analyzing unique business models like Marriott's asset-light structure combined with aggressive share buybacks. It's true that while Marriott generates immense cash flow and boasts strong profitability, its return on equity, ROE, can sometimes appear low or even negative on the surface. Now, this isn't necessarily the red flag it might seem for a company like Marriott, which, as you noted, very aggressively buys back its own shares using that free cash flow. Those large-scale share repurchases significantly reduce the amount of shareholder equity recorded on the balance sheet. Equity is the denominator in the ROE calculation, net income shareholder equity. So mathematically, shrinking the denominator through buybacks can make ROE look artificially low, or even turn negative if equity shrinks substantially over time due to sustained repurchases, even while net income remains strong. What we should probably focus on instead For this specific asset-light model are metrics like their consistently strong return on invested capital, ROIC, which measures profit relative to all capital invested, including debt recently cited at a very healthy 19.79%, and of course their robust free cash flow generation itself. These metrics provide a much clearer picture of how efficiently Marriott is actually deploying its capital, both debt and equity, to generate profits, rather than getting potentially distorted by the accounting effects of share buybacks on the equity line alone.
Okay, that makes a lot more sense. It's about looking at the right metrics for the right business model. So it sounds like they're very disciplined with their capital allocation. Can you give us a sense of the sheer scale of those returns back to shareholders? How much are we talking about?
Precisely. Marriott has a very clear and disciplined capital allocation strategy, heavily focused on returning excess cash to shareholders once growth needs are met. For example, back in 2019, before the pandemic disrupted things, the company returned over $2.7 billion to shareholders through buybacks and dividends. Then, after a necessary temporary suspension of returns in 2020 to preserve liquidity during the crisis, capital returns resumed and accelerated significantly as the recovery took hold and cash flow surged back. In 2023, Marriott returned over $4.5 billion to shareholders. That consisted of a whopping $3.9 billion primarily in share repurchases and over $600 billion in dividends. And for 2025, the company is currently on track to return approximately $4.0 billion. This consistent large-scale return of capital is really a core tenet of their investment proposition, made possible again by the unique financial characteristics of their asset-light model and their ability to generate billions in free cash flow year after year. Now, while the majority of that excess cash typically goes back to shareholders, capital is also strategically deployed for growth initiatives. This includes what's often called key money in the industry, basically. Financial incentives, which might be structured as loans or even small equity investments, that Marriott sometimes offers to hotel owners to secure new, high-potential management or franchise contracts. It's essentially buying market share quickly and efficiently in strategic locations or segments. They also, of course, continue to invest in their technology platforms and brand development initiatives to maintain that crucial competitive edge we discussed earlier. In terms of overall financial health, Marriott maintains a pretty robust balance sheet. As of Q2 2025, they reported $15.7 billion in total debt and about $0.7 billion in cash. They actively manage this debt profile with a stated goal of maintaining their investment-grade credit ratings. They target a key leverage ratio net debt to adjusted EBITDA in the 3.0 to 3.5 times range, which generally ensures strong financial flexibility while still allowing them to use debt strategically to enhance returns.
Right. So there's always this delicate balance, isn't there, between those aggressive shareholder returns, which investors obviously like, and reinvesting enough back into the business to fuel future growth, especially in this current environment where growth seems to be moderating. How do they strike that balance effectively year after year?
It's a constant evaluation, absolutely. It's probably the key question for their management team and board. In a moderating growth environment, the emphasis might shift slightly. Share buybacks remain particularly attractive because they directly enhance earnings per share, EPS, growth, even when overall revenue growth is harder to achieve organically. Fewer shares outstanding means higher EPS for the same level of net income. However, Marriott also absolutely has to strategically deploy capital into its development pipeline, technology upgrades, and brand innovations to ensure future growth potential isn't sacrificed. You can't just return all the cash. Their typical approach seems to be to fully fund the highest return internal growth initiatives. First, things like key money for the best pipeline deals, essential technology upgrades, promising brand development pilots, and then return the excess free cash flow that remains back to shareholders, primarily via buybacks. The high ROIC they achieve on many of these internal investments means these capital deployments are generally very efficient uses of capital anyway, so that it's usually not framed as a strict either choice between growth and returns.
It's more about a disciplined prioritization based on maximizing long-term shareholder value, but with a strong, demonstrated bias towards cash returns when attractive internal investment opportunities become scarcer or yield less than optimal projected returns compared to just buying back stock.
Okay, so looking forward then, what are the key tangible growth drivers for Marriott? Where are they finding new opportunities to expand their empire in this more normalized market, especially given that the big U.S. domestic market seems to be showing signs of slowing down?
Marriott's future growth trajectory is fundamentally underpinned by its truly industry-leading development pipeline. This is a massive asset. That pipeline reached a new record size of more than 590,000 rooms spread across approximately 3,900 properties as of the end of the second quarter of 2025. This provides incredibly high visibility into future unit growth and therefore future fee growth. It's not speculative. These are hotels under contract. We can clearly see a significant stream of new revenue coming online over the next several years. And importantly, over 238,000 of those pipeline rooms were already physically under construction as of that date, meaning they're on a relatively near-term path to opening their doors and starting to generate fee revenue for Marriott. Just for context, again, even a large competitor like Hilton had a pipeline of about 462,400 rooms at the end of 2023. So Marriott's scale, even in terms of future growth potential, is clearly superior, creating a powerful ongoing competitive advantage.
And where are they actually building or planning to build all these hundreds of thousands of new rooms? Is it still heavily focused on their home market in the US and Canada, or are they strategically diversifying geographically to find that growth?
That's a vital strategic point, and the answer is quite clear. Interestingly, over half of this impressive pipeline, more than 50% of those 590,000 plus rooms, is located in international markets outside of North America. This strategic emphasis aligns perfectly with current global industry trends, as international markets, in aggregate, are generally exhibiting stronger RevPAR growth right now than the more mature and now normalizing U.S. and Canada region. For example, back in Q2 2025, Marriott's international RevPAR grew by 5.3%, while, as we noted, U.S. and Canada RevPAR was basically flat year over year. This geographic diversification is absolutely key. It allows Marriott to tap into faster-growing economies, emerging middle classes with growing travel demand, and developing travel markets, effectively hedging against potential slowdowns in their most established regions like North America. Now, the conversion of this robust development pipeline into actual open operating hotels translates directly into net rooms growth, which is a direct driver of Marriott's recurring fee revenue base. Marriott achieved net rooms growth of 4.7% back in 2023, which is their highest rate since 2019 before the pandemic hit. And management is currently guiding for net rooms growth to approach 5% for the full year 2025. This consistent, significant expansion keeps adding compounding layers to their future fee revenue potential.
Yeah, and I can imagine that converting existing hotels over to a Marriott brand must be a quicker, maybe more capital efficient way to grow that room count compared to building entirely new hotels from the ground up, especially with those high construction costs and interest rates we discussed earlier. Is that conversion strategy a big part of their plan too? And what about expanding into completely new market segments where they might have been underrepresented before?
You're absolutely spot on. A significant and growing component of Marriott's growth strategy is indeed the conversion of existing hotels. These could be independent properties looking for more firepower, or maybe hotels currently operating under a competitor's brand flag, converting them over to a Marriott flag. Conversions are incredibly attractive for several reasons. As you said, they're generally much faster to execute than new build construction. They're less capital intensive for the hotel owners, which is appealing in the current environment. And they often bring immediate incremental fee revenue to Marriott almost as soon as the deal is signed and the flag goes up. In the first half of 2025, conversions represented approximately 30% of Marriott's total room signings and openings, which really underscores their importance and efficiency as a growth lever. Now, complementing this conversion strategy, Marriott also strategically launches or acquires new brands that are specifically targeted at previously underserved market segments or geographies. For instance, the 2023 acquisition of the City Express brand portfolio was a very targeted move to establish a significant presence in the affordable mid-scale segment across the Caribbean and Latin America, a massive growing market for value-conscious business and leisure travelers where Marriott had previously lacked scale. Similarly, the relatively recent launch of their Series by Marriott Collection brand is specifically designed to attract existing independent hotels that want to retain their unique identity and local character, but desperately need access to Marriott's powerful global distribution system and that huge Bonvoy loyalty program member base. These are all smart, capital-efficient, strategic ways for Marriott to expand its reach, capture new market opportunities, particularly in growth segments, and bolster those all-important fee-based revenue streams for the future.
Okay, so Marriott's clearly been incredibly active over the last few years. They haven't just been, weathering the storm of the pandemic and recovery. They've been making some really significant proactive strategic moves that seem designed to solidify their dominance even further. What have been some of the most impactful maneuvers and key milestones during that, say, 2022-2024 period? And how do they really fit into the bigger picture of their strategy?
Yes, this period was certainly marked by the continued recovery, absolutely, but perhaps more importantly by some aggressive and quite visionary strategic actions on Marriott's part. A major operational milestone occurred by June 2022, when Marriott's global RevPAR officially fully recovered back to the pre-pandemic 2019 levels. That was a big psychological and financial turning point. This momentum continued, as we saw,
fueling those record financial results in 2023 before the market really began its shift towards that more normalized growth pattern in 2024. Now, a huge catalyst for that growth surge in 2023 was undoubtedly the lifting of those long-standing, strict COVID-19 travel restrictions in Greater China. That unleashed a massive wave of pent-up demand, with RevPAR in the Greater China region increasing by a phenomenal 71.7% year-over-year in 2023. It just demonstrated the enormous latent demand sitting in one of the world's largest and fastest-growing travel markets.
Wow, 71.7%. That's a massive jump. And they also made some very smart-looking acquisitions and partnerships during this time too, didn't they? You mentioned platformization earlier when we discussed their scale. Can you explain how that concept plays out in these specific strategic maneuvers they've made recently?
They absolutely did, and these moves demonstrate a clear and very effective focus on what we can call platformization. It's a powerful concept for them. This is essentially about leveraging Marriott's immense established ecosystem. Think the 248 million Bonvoy members, its incredibly powerful global distribution network reaching every corner of the globe, its sophisticated digital marketing engine, and its decades of operational expertise, leveraging all of that as a kind of plug-and-play solution for existing hotel owners or even entire hotel portfolios. So instead of a competitor needing to build all of this complex infrastructure from scratch over decades, Marriott offers a ready-made, highly efficient commercial platform. This allows them to attract and integrate existing hotel portfolios far more easily and much more capital efficiently than a smaller player ever could. They can instantly add thousands of rooms to their system without significant direct capital outlay. A prime example, as we touched on, was the 2023 acquisition of the City Express brand portfolio. This was a very targeted move to establish a significant presence in the affordable mid-scale segment across the Caribbean and Latin America, adding roughly 17,500 rooms directly into their system in a high-growth region and a segment where they previously lacked scale.
Right. And then there was that huge landmark deal with MGM Resorts. That one really felt like a potentially game-changing partnership when it was announced. Can you elaborate a bit more on the strategic rationale behind that deal? Why was Las Vegas in particular so crucial for them, and what does this partnership really bring to the table for Bonvoy members?
Yes, the MGM deal was indeed a landmark agreement. It was a capital-light masterstroke, really, that dramatically expanded Marriott's luxury and lifestyle offerings almost overnight. The 2023 strategic licensing agreement with MGM Resorts International effectively brought 17 of MGM's premier resorts, think Bellagio, Aria, MGM Grand, representing approximately 37,000 rooms, into Marriott's global distribution system. This created the new MGM collection with Marriott Bonvoy, and it was a strategic coup on multiple fronts for Marriott. First, as you mentioned, it significantly bolstered Marriott's presence in the absolutely key Las Vegas market. Vegas is a top global entertainment and convention destination, and Marriott previously had a relatively smaller footprint there compared to some competitors. This instantly made them a major player. Second, it diversified Marriott's offerings significantly into the highly lucrative gaming and large-scale entertainment resort segment, potentially appealing to a different type of traveler demographic than their traditional base. And for Bonvoy members, it opened up an entirely new and exciting world of redemption possibilities and elite status benefit recognition at these iconic Las Vegas properties, effectively making their Bonvoy membership even more valuable and, hopefully, more sticky. More recently, the 2025 acquisition of the Citizen M brand, known for its affordable luxury, tech-forward approach and focus on urban locations, is another clear example of this surgical approach to M&A, targeting specific, growing market niches with unique brands. And beyond these major deals, throughout this period, the company continued its heavy multi-year investment in technology, constantly aimed at enhancing its digital channels, improving operational efficiency behind the scenes, including those ongoing upgrades to its reservation systems and the Bonvoy app, which are absolutely critical for driving those profitable direct bookings we keep coming back to.
That's a fascinating level of integration, especially pulling in huge established brands like MGM's. But these large integrations, they must come with significant execution risk, right? What are the biggest hurdles they likely face in actually bringing these vastly different types of properties, like giant Vegas casinos, smoothly into the broader Marriott ecosystem while still maintaining consistent standards and, importantly, the integrity of the Bonvoy loyalty program for everyone?
You've absolutely hit on a crucial point there. While these deals are often described as capital light for Marriott, they are anything but risk-free when it comes to execution. The biggest hurdles typically involve technological integration. Just imagine trying to bring MGM's potentially decades-old, complex reservation systems, property management systems, and their own loyalty program, M Life Rewards, now part of Bonvoy,
together seamlessly with Marriott's global platforms. That's a monumental IT undertaking with huge potential for glitches. Then there's the challenge of operational standardization and cultural alignment, ensuring that MGM properties, which have traditionally operated under their own very distinct service ethos and operational procedures, now meet Marriott's global brand standards while still retaining the unique appeal that made them successful in the first place. That's a very delicate balancing act. And for Bonvoy, the challenge is ensuring a consistent and rewarding experience for members across these new, often incredibly complex resort environments, which might have different rules around benefits or points earning than a standard Marriott hotel. It requires extensive cross-training of staff, clear communication between the organizations, and carefully defined guidelines. Delays in integration, unexpected cost overruns, or operational disruptions that impact the guest experience are always significant risks with such large-scale, complex initiatives. Marriott certainly leverages its deep integration experience from past major acquisitions, most notably Starwood, but it's undoubtedly a constant tightrope walk to realize the full strategic value of these deals without alienating existing customers, confusing employees, or damaging brand reputation along the way.
Okay, so while Marriott has clearly been making some very savvy plays and recovering strongly financially, the horizon isn't entirely clear skies, is it? What are some of the persistent headwinds and ongoing risks that they're still facing, things that could potentially impact their trajectory moving forward?
No, it's definitely not all clear skies. Unfortunately, the industry as a whole continues to face persistent labor shortages and related wage inflation. This isn't just a minor inconvenience. It puts relentless upward pressure on operating costs for Marriott's managed hotels and, very importantly, for its thousands of franchisees. This can potentially compress property-level margins, which, as we discussed, can indirectly impact Marriott's own incentive fee earnings. It's a fundamental challenge right across the sector, and it's forcing operators to innovate rapidly in areas like staffing models, automation, and technology to boost productivity. Beyond labor, those structural shifts in business travel patterns due to the rise of remote and hybrid work models continue to create long-term uncertainty. While leisure offers a partial offset and a new growth avenue, a potential permanent reduction in traditional high-frequency business transient demand remains a structural risk, particularly perhaps for the select service brands like Courtyard or Fairfield Inn, which historically relied very heavily on these short, frequent business trips during the week. Recent results have even shown specific pockets of weakness in demand from government travelers and smaller business customers, indicating this isn't just a theoretical concern. It's showing up in the data.
And they're still up against the alternative accommodation platforms too, right? Companies like Airbnb and Vrbo. That market seems to have firmly cemented its place in the overall travel landscape now.
Yes, absolutely. The alternative accommodation platforms like Airbnb and Vrbo continue to pose a significant competitive threat, especially perhaps for leisure travelers and those looking for longer-term stays. They appeal strongly to certain demographics seeking unique, more localized or residential-style experiences, often at a different price point or configuration than traditional hotels typically offer. They've carved out a large niche. And of course, as a truly global company, Marriott is intrinsically exposed to geopolitical risks. They specifically noted an impact from the conflict in the Middle East on their performance in that region in mid-2025, which just demonstrates how quickly global instability can directly affect travel patterns and regional profitability. More broadly, a significant global economic downturn would inevitably reduce both corporate and leisure travel budgets significantly, which would negatively impact demand, occupancy, and pricing power right across all of their brands, regardless of how dominant their market position is. No one is immune to a deep recession. Finally, cybersecurity and data privacy remain significant and, frankly, ever-growing risks, given the vast amounts of sensitive customer data, credit card numbers, personal information, travel patterns handled by the industry every single day. Marriott has unfortunately incurred costs from security incidents in the past, which underscores this ongoing threat and the constant, costly need for robust data protection measures and vigilance against cyber attacks. This really raises an important overarching question. Just how adaptable and resilient can even the largest, most sophisticated players like Marriott be in the face of these deep structural shifts in travel behavior and these unpredictable external uncertainties that are constantly evolving? It's not just about driving growth anymore, but about building and maintaining that agility and resilience in what seems like a perpetually changing global environment.
So how does Marriott specifically try to mitigate these multifaceted risks? For example, how do they actively counter the ongoing rise of Airbnb beyond just existing? And what's their labor strategy realistically beyond just paying higher wages, which might not be as sustainable long term?
Right, it's a multi-pronged approach, really. To counter the alternative accommodations threat, Marriott emphasizes the inherent advantages of traditional hotels: reliability, consistent brand standards, professional service, safety protocols, and amenities like gyms or restaurants that most rentals lack. They also heavily promote the benefits of the Bonvoy loyalty program, offering tangible rewards, elite status perks, and an integrated digital ecosystem that independent rentals simply can't match. Consistency and loyalty are their weapons. They're also strategically launching new brands, like the Extended Stay Studios concept, which directly caters to longer stay, more value-conscious travelers, effectively competing more directly in a segment where Airbnb has historically been very strong. On the labor front, beyond competitive compensation and benefits packages, they are investing heavily in technology designed to boost employee productivity. Think AI-powered chatbots for guest services that can offload some routine front desk tasks or optimize scheduling and housekeeping management tools. They also focus strongly on creating a positive company culture, offering training and career development opportunities to try and improve employee retention and reduce costly turnover, recognizing that their frontline human capital remains an incredibly valuable asset, even in a tech-enabled world. It's really a holistic strategy combining brand differentiation, technological innovation, strategic investment in new segments, and a focus on their workforce.
Okay, so we've covered a lot of ground. We've talked about the evolving industry, Marriott's formidable competitive position, its impressive, albeit recently moderating, financials, and the significant challenges and risks it still faces. Now, let's get to the critical question for many listeners. What's the market's verdict on all this? How does Marriott's valuation actually stack up today, given everything we've discussed? Is it expensive, cheap, fairly valued?
Well, Marriott consistently trades at a premium valuation compared to many other hotel companies. And that premium really reflects its unparalleled industry leadership position, its strong global growth prospects fueled by that pipeline, and its disciplined, consistent shareholder return policies, which are highly valued by the market. As of September 2025, looking at the numbers, Marriott's enterprise value to trailing 12 months EBITDA multiple, that's EBITDA, a common valuation metric, was hovering somewhere in the range of 19.2x to 20.1x. Now, this is broadly in line with its own long-term 13-year median multiple of about 19.4x. This suggests that the market currently views its earnings power as, let's say, fairly valued relative to its own history. It's not at a cyclical low or a speculative peak. However, it is well below some of the peak multiples we're seeing during periods of rapid post-recession recovery in the past, when future growth expectations were perhaps higher. Looking at another common metric, its trailing 12 months price to earnings, or PE, ratio stood at approximately 29.8x around the same time.
Taken together, these figures suggest that the current valuation reflects more normalized market expectations for Marriott's ongoing earnings power and future growth trajectory, rather than extreme optimism or pessimism. The market seems to have digested the big recovery story and is now looking at its sustainable longer-term performance potential.
Okay, so it's not cheap historically, but maybe not wildly overvalued either, at least based on its own track record. How does that valuation compare to its direct competitors in the hotel industry right now? Does its clear market dominance seem to justify that premium valuation relative to its peers?
Yes, if we connect this valuation to the bigger picture of its peer group, Marriott consistently trades at a noticeable premium to most of its direct competitors, which clearly indicates the market's preference for its scale, its brand portfolio strength, and its perceived strategic advantages. For instance, around mid-2025, Wyndham Hotels and Resorts was trading at approximately 14.9x EBITDA, and Choice Hotels was around 13.5x, considerably lower. Now, while Marriott's multiple was currently below Hyatt's, which stood at a higher 23.8x, Hyatt often gets valued partly as a growth story due to its smaller size and luxury focus. Marriott's valuation was actually comparable to, or perhaps slightly below, Hilton's, which according to some sources was trading at a significantly higher 29.7x EBITDA. This really indicates the market's clear preference for scale, strong brand equity, and predictable growth among the dominant global players like Marriott and Hilton. The market rewards that perceived stability and reach. Looking at Table 5 from our sources provides a useful direct comparison of these EV/LTM, EBITDA, and LTM PE multiples for Marriott and its key competitors as of mid-2025. And it clearly shows this valuation premium that Marriott generally commands. And as we discussed earlier regarding its business model, free cash flow, FCF yield, is also a particularly relevant valuation metric to consider for Marriott's highly cash-generative operations. Its consistent ability to generate billions in operating cash flow,
much of which becomes free cash flow, strongly supports its current valuation in the eyes of many investors who prioritize cash returns.
So, putting that all together, what does this really mean? It seems the market is effectively pricing Marriott not just as a traditional hotel operator that owns and runs hotels, but more like a best-in-class capital-light platform business. Is that fair? A platform with a highly visible growth algorithm built around its pipeline and fees, one that consistently delivers strong shareholder returns. It seems it's being valued for its quality, its consistency, its unparalleled global reach, and maybe especially for those intangible assets you highlighted earlier, the power of the Marriott Bonvoy brand, the loyalty program's lock-in effect, the global distribution network. The market seems to be fully appreciating those aspects. All right, now let's try to crystallize the core arguments both for and against investing in a company like Marriott at this juncture. Based on everything we've covered, what's the strong bull case? What are the key reasons someone would be optimistic about Marriott's future?
The bull case for Marriott is indeed quite compelling, and it's really built on several key pillars that form a powerful investment thesis. First and foremost are its sustainable competitive advantages, which are arguably unmatched in the industry. We're talking its unparalleled global scale, the industry's most diverse and extensive brand portfolio covering nearly every segment, and of course the world's largest and most powerful hotel loyalty program, Marriott Bonvoy. This combination creates that self-reinforcing virtuous cycle that consistently drives demand towards its properties and significantly raises the barriers to entry for any potential competitor. It's a deep moat. Second, its capital-light, high-return business model is a major draw for investors. That disciplined adherence to managing and franchising rather than owning minimizes capital requirements, generates substantial and predictable free cash flow year after year, and enables those consistent large-scale capital returns back to shareholders, particularly through those billions spent on share repurchases. Its return on invested capital, ROIC, was recently cited at a very healthy 19.79%, showcasing truly exceptional capital efficiency. Third, Marriott boasts the industry's largest, most visible, and geographically diversified development pipeline. This provides a clear and reliable path to future net rooms growth and, consequently, fee growth over the next several years. And that growth is increasingly being driven by faster-growing international markets, capital-efficient conversions of existing hotels, and strategic expansion into new segments like midscale, making the growth story seem quite robust and de-risked to some extent. And finally, there's that significant operating leverage embedded in its financial structure. The fee-based model, especially those incentive management fees that are directly tied to hotel profitability, means Marriott's earnings per share can actually accelerate faster than its overall revenue growth during favorable market conditions, offering powerful potential upside to investors when the cycle turns positive.
Okay, those are definitely powerful arguments for the bull case. But as we know, no company, not even one as dominant and well-run as Marriott appears to be, is entirely without its risks or potential downsides. So what's the counterargument? What keeps cautious investors up at night when they think about Marriott, and what forms the core of the bear case against the stock?
The bear case also has strong, undeniably valid points that absolutely warrant careful consideration by any potential investor. The first, and arguably the biggest, is the inherent cyclicality and macroeconomic sensitivity of the entire lodging industry. It is fundamentally a consumer discretionary business at its core, making it highly sensitive to the ups and downs of the broader economic cycle. A significant global recession, like the one triggered by the pandemic or the 2008 financial crisis, would almost certainly severely impact both corporate and leisure travel spending, leading to lower occupancy, reduced pricing power ADR, and ultimately lower profitability for hotel owners and lower fees for Marriott. The nearly 50% revenue drop Marriott experienced in 2020 underscores this profound, unavoidable cyclical risk. Second, there's the concern around moderating growth in its key U.S. market. The clear deceleration we're seeing in RevPAR growth in the large and mature U.S. and Canada market, coupled with those specific pockets of weakness noted in the select service segment, signals potential broader slowdowns ahead that could temper Marriott's overall performance if international growth can't fully compensate. Third, execution and integration risk is always present, perhaps even amplified, for a company undertaking initiatives of this scale and complexity. Marriott faces intricate, multi-year technology transformations to modernize its core systems, alongside the ongoing integration of newly acquired brands and large strategic partnerships like City Express, the massive MGM collection, and citizenM. Any significant delays, unexpected cost overruns, or operational disruptions during these complex integrations could negatively impact results or brand perception. And finally, that premium valuation and the resulting high expectations mean there's arguably less room for error for Marriott compared to more cheaply valued peers.
Its premium stock price implies high market expectations for continued growth and profitability. Any failure to consistently meet those targets could potentially lead to a significant derating of its stock multiple. And while its substantial debt load appears quite manageable now and is being strategically deployed, it could become a greater concern in a prolonged economic downturn or a sustained high interest rate environment, potentially constraining financial flexibility just when it's needed most.
Right. So, what does this all really mean at the end of the day? It means carefully weighing up those powerful, almost unassailable competitive advantages, that deep economic moat, the proven resilience, the cash generation, against the unavoidable realities of operating in a highly cyclical industry and navigating the constant pressures of a dynamic, complex, and sometimes uncertain global market. It's a delicate and continuous balancing act that any investor looking at Marriott really needs to assess for themselves based on their own outlook and risk tolerance. Hashtag outro. Well, we certainly journeyed deep today through Marriott's dominant position in global hospitality, its clever capital-light business model that fuels that prodigious cash generation, its truly impressive financial rebound from the depths of the pandemic, and also the dual forces of immense opportunity and significant challenge that seem to define its path forward from here. It's absolutely clear why Marriott remains such a closely watched, often admired, and strategically important company in the global economy.
And, this really raises an important, maybe broader question for all of us to think about. Considering Marriott's somewhat unique financial profile specifically, how its return on equity can sometimes appear negative due to those aggressive share buybacks, which is unusual. And knowing that its intangible assets, things like its brand equity built over decades, its global distribution reach, and especially that massive Bonvoy loyalty program, are arguably its true powerhouse assets. How much of its enduring value, its real economic worth, is truly represented by traditional tangible balance sheet metrics anymore? And perhaps more importantly, what does that realization mean for how you, as a discerning observer or a potential investor, should think about assessing a company's financial health and its long-term potential in our modern economy, where things like brand power and customer connection can often seem to outweigh physical assets on the ground?
Definitely something interesting to ponder, perhaps on your next stay, whether that's a quick business trip or maybe a longer, leisurely extended vacation. Is Marriott's premium valuation simply a fair reflection of an unparalleled, best-in-class business that's truly built to last through almost any economic tremor? Or does that premium price perhaps leave it more vulnerable than others to the slightest macroeconomic shift or competitive disruption? Thank you for joining us on this deep dive into Marriott International. We certainly hope it gives you a fresh perspective the next time you check in, or maybe just see one of their many brands on a street corner somewhere in the world.